Hey everyone, we're going to carry on with CGT where we left off. Maybe you can see it's a new day because I'm wearing a different shirt, so the CGT recording's taken more than one day. But we're going to pick up where we left off from video number 3. I think this is video number 4 now. And let me make it big screen for you. Here we go. So where we got to was paragraph 12a. Now paragraph 12a can be a slightly difficult one. And it deals with something known as debt reduction. Now, what debt reduction is when a debt owed by a person is reduced, there is a reduction amount. Now, that's not saying too much. The best way to look at it is to look at the actual definition. And it says, a reduction amount is the amount of the debt reduction as it is greater than any consideration paid by the debtor. So what this basically means, to put it in nice normal words, if any debt that you owe is reduced by more than what you actually paid, then there's going to be some kind of a debt reduction. Basically, it's the amount of debt that is forgiven. So you owe somebody 100 Rand, they say now you only owe us 50, there's a debt reduction of 50 bucks. Now, the big picture, why we need to think about this, big picture, I'll make the picture big. Why we need to think about this is, let's think of a scenario where you buy an asset for 100, you claim allowances on it based on 100, but right after you buy it, the person you bought it from says, actually, you don't have to pay me 100, just pay me 50. Now we've got an issue of them possibly having some kind of a reduced inclusion in gross income, or getting some kind of deduction for that debt that they've forgiven. Whereas us, we still have that asset worth 100 on which we're going to be claiming allowances. So you can see that there's a problem, and there may be a mismatch between the two sides of the transaction, and SARS doesn't want that. So what we're looking at here is circumstances where there's been a debt reduction, there's a reduction amount. So the amount that we owe has been reduced, and it's not reduced just because we paid it. It's reduced because the person's forgiven it. And that debt was used to fund the purchase of some kind of capital asset. Now, in the previous wording of the legislation, they made differentials between a capital asset and an allowance asset. A capital asset, one that does not receive allowances, and an allowance asset, obviously one that does. When you look at your most recent version of the Act, you will see that that wording is no longer there. So they don't bother to differentiate between the two types of assets. But in truth, the way you treat them is still going to be exactly the same way as you treated them last year. So let's actually look and see what happens. This slide I'm putting here for you just to put a cross through, the reason being is that this is pre-2019. I need you to know that this existed and that it changed in 2019. So this is how they used to do it. This is how we do it now. The only difference in previous years is the presence of this point number 2. So if ever you're doing old questions and you see this, where they're using a reduction amount to reduce a capital loss, an assessed capital loss from a previous year or current year, know that that's the old way of doing it. The new way doesn't have this. Okay. All right, we continue. You may have noticed a little pause in the recording there. I was being very sneaky. I realized I used the old version of the slides, so these ones are going to be right, and other ones you'll have on a Canva. Where we were, the slide is exactly the same, but what we need to first look at here is to say, well, whenever there is a debt reduction, we do two things. We take that amount of reduction, so however much debt has been forgiven, and we use it to reduce the base cost of whatever asset it relates to. So the reason that we do this is we say, well, we bought this asset, but actually the debt that we incurred to buy this asset, some of it or all of it, we no longer actually have to pay. Because of that, we need to now do something that's going to reduce the value of this asset for tax purposes, and the best way to do that if it's a capital asset is to reduce the base cost. That's going to mean when you dispose of it, your base cost is going to be lower, which means your CGT is going to be higher because it's going to be expected to result in a higher capital gain. So reducing the base cost is a way to take into account the fact that you actually, in the end, didn't have to pay for all of this asset. But there is a slight problem. For an asset which doesn't receive any allowances, you can reduce the base cost, and obviously that base cost is going to be equal to what you paid for the asset, which is equal to the base cost. So if you're going to ever reduce this debt, the most it could ever be reduced by is the base cost. So when you look at this option here, there's no way that the reduction amount would ever be bigger than the base cost because there's no allowances. Your base cost is going to be equal to what you paid, and the debt reduction can't be more than what you paid. Okay, so there's not really a possibility for there to be an excess. However, if you have an allowance asset, so this is an asset in which you receive capital allowances. Remember what those capital allowances do. They reduce the base cost. So if you had a situation where you bought an asset, you've been reducing it by the allowances for a few years, and then let's just say they forgive all of the debt 2-3 years later, you're going to have a situation where your current base cost, which has been what you paid for it, less all the allowances, when that's reduced by the full amount, you're going to have an excess. It's going to reduce that below zero. And if you have that situation, that excess is going to be recouped through gross income, not through just the reduction of base cost. And the reason that you have that recoupment is because you were able to claim those allowances and reduce your taxable income, and now they're saying that you have to add it back because in truth you didn't actually end up paying for those assets, or you paid but you didn't have to end up giving it all to the person because the debt was forgiven. Okay. If it's a little bit complex, take a step back, pause it, watch that one more time. And what we're going to do now is think about a slightly bigger complication. This all makes sense if you still have the asset. All right, so you still have the asset, you haven't yet sold it, the debt's forgiven, you can reduce the base cost, no problem. What happens though if you buy the asset? Debt forgiveness takes place 2 years later, but within those 2 years, you've actually disposed of or sold the asset. You're not going to have this ability to reduce the base cost to affect CGT because you did CGT when you sold it a year ago. So that raises a problem. Now, that problem is dealt with, and the way it's dealt with is as follows. What you're going to see here is quite similar on both sides. What you have to do if debt forgiveness takes place after you've sold the asset, you have to go back and recalculate the gain or the loss that you calculated when you sold the asset as if the debt reduction took place then. What I mean by this, if you sold it last year and you worked out that there was a capital gain of this much, you need to this year go and recalculate that number and taking into account that debt forgiveness, reducing the base cost, and work out what the new capital gain would have been. So if you previously had a capital gain of 100 Rand and you go and work it out now and you have a capital gain of 300, you can see that there's a difference. Now that debt forgiveness is going to reduce the base cost, which is going to always make your capital gain bigger or make your capital loss smaller. So it's always going to be a way of increasing the tax in some way. Now, what you're required to do in these scenarios is to say, well, hey, if it was 100 and it's now 300, the difference is 200. I have to recognize that 200 as a capital gain in the current year. I'll repeat that one more time. So if you had previously worked out it was 100, you now worked out that it actually should have been 300 with the debt reduction, you have to recognize the difference of being 200 as a capital gain in the current year. You don't recognize the 300 because, hey, you've already recognized 100. It should be 300. You recognize the difference in the current year as 200 capital gains. If it is an asset which received allowances, there's one more layer of complexity, and that is that you're also going to have to recalculate the recoupment. If there was a recoupment previously, and you work it out now again, you redo the recoupment calculations using the new base cost. Once you've done that and you work out there's a change in the recoupment, let's say the recoupment was 100 and now it's 300, you have to recognize that difference as a recoupment in the current year as well. Best way to look at this is to do an example. Okay, so here we have a situation that I want you to read through on your own as time allows. But basically what we have is a situation where somebody forgives 20% of the outstanding amounts. Okay. What we have in this situation is to say, well, we owed 500, 20%'s been forgiven, so that is the 100. Okay, we're paying 20. Sorry, everything else is forgiven. So it was 500, we paid 100, and that means that 400 of it was forgiven. That's going to be the debt benefit amount. I think that's quite an easy example to start off with. The slightly more difficult examples come in when we start looking at actually applying it. Now what we have in this scenario is we borrowed 3.5 million from a bank. We started experiencing financial difficulties, so the bank cancelled 1 million of it. Note that we used the 3.5 million to buy plant and machinery. We ask ourselves the following process. Number one, has there been a debt benefit? Yes, there has. 2, is it specifically excluded? Now, what I want you to do every time, have a look at paragraph 12a. There's a list of exclusions there that are things that mean 12a will not apply. One or two of those won't make a huge amount of sense, but have a look through that list, look in your textbook as well, and you will notice that there's a couple that you may come across. 12a, for example, will not apply to a donation. So a donation that counts for donations tax will not attract 12a. Or anything that you're using to settle a divorce, for example, or any debts owed to a deceased estate, or the certain winding up of companies, 12a will not apply for, or to. Third question, ask why you took out this debt. Was it used to fund a capital asset? And if it was, and you meet those things, then you go into the next step. What we have here is to say, well, here's what we bought the asset for, 3.5 mil. Here's the allowances that we've previously claimed. So that gives us our remaining base cost when the debt benefit happened. The debt benefit was a mil. So all this does is it resets our base cost. Okay. It makes the base cost lower. This example is a little bit easier because we haven't yet sold the asset. Example part 2 speaks about scenarios where we've now actually sold the asset. I want you to read this in your own time. I'm not going to read it to you, but the situation here is that there's a debt benefit and we've already sold some of the assets. Okay. So what you need to ask yourself, again, is there a debt benefit? Yes, there is. Is it on the list? No, it's not. What was the purpose of this debt? It was to buy the pieces of land. So it all applies. For vacant lot 1, it's quite simple because of the debt reduction, you still hold the asset. You just reduce the base cost. It's land. There's no allowances. You're good to go. The issue with vacant lot 2 is that we've already sold it. So we've worked out that we had a gain. Okay, we actually worked out that we had a loss. Now we rework it out and we work out we have a gain. So the loss, the difference between the original loss of 800,000 and the new capital gain of 1.2 is actually 2 million. I hope you can see that we're going from minus 800 to plus 1.2. The difference is 2 million gain, and that we recognize in the current year. I want you to take a bit of time, do these examples, make sure that you understand them, and most importantly, make sure you can understand if example 2 related to an asset which received allowances. If you can do that, that's about as hard as a 12A question could get.